Welcome everyone to Daily Mortgage Rates Live with the Mortgage Calculator. What we're going to do today is go through some live mortgage rates, and then we'll do a little deep dive into a topic, and today's topic is going to be FHA loans. We're going to continue taking it back to the basics here. So feel free to drop a comment here while we go live on all the different platforms. Give us just 1 minute. We are streaming live on YouTube, Facebook, Instagram, and LinkedIn. So let us go live on all the different platforms, and then we will get started. Feel free to drop a comment there in the meantime. Hope everyone's been having a great week. It's going by really quick, already Thursday. Good morning to everybody that was already dropping comments there in the chat. We appreciate it. We'll get started here momentarily. Good morning, good morning. All right, it looks like we are live on all the different platforms, so we can go ahead and get it started. We'll take the chat off the screen here. There we go. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do on this show every morning is go through the live mortgage rates and then do a deep dive into a different loan topic. Today's topic is going to be fitting right in with what we've been doing this week, which is really taking it back to the basics here this week for our deep dive topic. So today's deep dive is going to be FHA loans, and maybe talk about some different type of FHA loans and things that you could do with FHA loans that you didn't know existed yet. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to do a deep dive into that shortly. But before we do that, what we'll do is we'll go ahead and pull up our pricing tool and go through the actual live mortgage rates for today. So Nick, let's go ahead and pull up the pricing tool and see what the market is looking like this morning.
All right, let me switch my screen and we'll get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. This will show us the general rates and the APR, including all the fees for today on July 20th. Since it's just after 11 a.m. Eastern, we have live rates for all our general programs. If you would like a full breakdown of all the fees that go into the APR, a full loan estimate, please get with our team members. We have over 300 licensed loan officers, and we can do primary and second homes and FHA loans, which is a topic for today, in 24 states. And we can do our business purpose DSCR loans in 44 states, which is something we also love as well. For all of our demos today, we'll set up a basic scenario here using the tool, a $400,000 loan amount. We will set a LTV of 80% loan, 20% down payment. We'll set a desired price of $99. That means we're going to ask the computer to find the best rate at one discount point in cost. And we're going to check out some different loan programs. We'll start with conforming. We'll go into our basic FHA demo. Obviously, Jose will have a few different variations of FHA here in a minute. And then we'll also check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. We also offer VA and USDA. VA is only for our eligible veterans and active service members. If you do happen to be eligible, let us know. We'd be happy to quote it, no problem. And same with USDA. That's only for properties that are eligible in a USDA rural area. If you do happen to be shopping there, let us know. We can quote it, no problem. We'll start today with conforming conventional. We will do a purchase, 30-year fixed loan, do primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos today, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with those settings, as we do every morning, let's check out the rates. Good. Looks like it's about the same as it was yesterday. 6.875 rate for one discount point in cost. Puts our final APR just a touch above 7 at 7.042. So about the same as it was yesterday. Again, things have been a little bit better than they were a few weeks ago. So definitely recommend our customers out there getting ready to lock those loans, pull that trigger. And remember, the APR is going to allow us to compare across programs. So we'll use the APR here to compare this conventional example to our next example, which will check out an FHA option. So if our customer doesn't qualify for conventional for any reason, typically the next best option is FHA. FHA programs do a little more leniency on the credit type of events and a much higher debt to income ratio that we can use. For the demo, though, we'll keep everything exactly the same as it was before, so we can compare apples to apples, the FHA rates to the conventional. So FHA did move a little bit yesterday. It looks like 6.25 rate for one discount point in cost puts our final APR, including the mortgage insurance, the upfront and yearly mortgage insurance for FHA, at 6.842. So compared that to conventional, it's actually a touch cheaper here for our customer that would qualify for both. The FHA program is actually a little bit cheaper. And our customer that only qualifies for FHA definitely gets a little bonus here with the changes they've made recently. So FHA here at 6.842, conventional was just over 7. Now, if our customer has any trouble qualifying for FHA or conventional, many other banks or lenders don't have other options, but that's where we specialize here at the Mortgage Calculator, where we have over 5,000 additional options under expanded guidelines, also known as non-QM. And we'll keep everything else the same, but we have a new button that pops up where we can change our income verification option. So full doc is 2 years of tax returns. That's what we have to use typically for FHA and conventional. So we would typically choose the non-QM option for one of these other options: asset-related programs, business bank statement programs, our investor programs we'll do in a second. Personal bank statement 12 month is our most popular program by far for a primary home. But we also have RSU, stated income, VOE, 1099, P&L, and the no income CDFI. But the most popular program by far is our 12-month personal bank statement, and that's for our self-employed borrowers. Many times our self-employed borrowers, when we do a full doc program with 2 years of tax returns, have different write-offs and may not qualify at all, or just may not quite qualify for as much income as they need. So in this case, we're allowed to use alternative documents, which would be their last 12 bank statements, no tax returns involved at all, to determine a debt to income ratio of 40% in this example, using just the cash in the bank rather than their tax returns. So most of our self-employed borrowers will qualify for double, triple the income and therefore can get the home they really want. So let's check out our non-QM solutions today. So the best option here at the top, 7.375 rate for 2.125 discount points and costs. It's a little more expensive here, but the final APR of 7.479. So remember, the conventional was just a touch over 7. Here we have a bank statement non-QM option for just a touch under 7.5. So a very comparable option. Remember, this is for a customer who would not otherwise qualify. Now has a very comparable rate and term and cost for a program that solves their problem. So we love these non-QM solutions. If you scroll down here, you see we have dozens and dozens of different options. Some of these options that are at a little bit higher rate may allow things like credit events and other guideline exceptions that we can make. So not only can we use alternative income, but with these non-QM programs, we can get around a lot of other issues that may come up for our borrowers. So we love these programs, especially when they're very comparable to conventional today. Now, before we go into Jose's examples, we always want to do some live pricing for investment properties. So we'll do a couple quotes here for investment properties. Whether you're a first-time investor or seasoned investor, we have a ton of options. So we'll set up the same scenario: 80% loan to value, 20% down payment. And then we'll compare our loan programs. We'll start with conforming conventional for a investment property. Then we'll check out our non-QM options. Remember, the government programs, FHA, VA, USDA, those aren't eligible for investments. So we'll start with conforming conventional. All we've changed here is the occupancy to investment. Everything else is exactly the same as it was before. So let's see what adjustments the conventional programs have made for investment. And it's a little bit more spendy than it was even yesterday. 7.125 rate, great rate there, but 4.125 discount points in cost. So these programs, these adjustments that they've made for investment properties on the conventional programs are pretty hefty. And the final APR, though, still very reasonable, 396. So for our customers that qualify for conventional, this is a great option, but most investors would rather go up a little bit on the rate in order to save. In this example, $16,500 in discount points is a lot of money that an investor can deploy elsewhere. So unfortunately, with conventional, there aren't a lot of higher rate options to reduce the discount points. So that's where we love to present our final demo for our non-QM investment property options. So set up the same scenario, switch to expanded guidelines, also known as non-QM. And now we have to select our income option, which is the most popular loan for an investment property. And our most popular loan here at the Mortgage Calculator by far is our DSCR loan. And that stands for debt service coverage ratio. That's because it doesn't actually require any income or employment from the borrower. We're simply going to use the estimated rental income from the property we're purchasing in order to determine a DSCR value. It stands for debt service coverage ratio. So if the estimated rents can cover the PITIA of the mortgage that we're proposing here, that is a ratio of 1.00 or higher, aka the property cash flows monthly. If the property doesn't quite cash flow monthly, that's a ratio of under 1.00, which we still have some options for. For the demo, we always select 1.5 since that's the highest value we have in our system. That way we can see all the different options. And then finally, for a non-QM investment property, we always must select the prepayment penalty option. We use 3 years. That's the standard for these programs. However, there are options for no prepayment penalty that will cost more and limit our loan programs. There are options also for 5 years to save some money there. Programs allow it. So for our demo, we always choose 3 years since that is the most common, so we can see the most options we have available. So let's see the DSCR rates this morning. All right, best option here at the top, 8% rate for 0.85 discount points and cost, and a final APR of 8.062. So obviously these programs are a little bit higher rate and cost, but we've solved our problem for our borrower here, where instead of $16,000, now the discount points are only $3,400. So most investors, when they're presented a conventional option with a DSCR option, about 90 to 95% of them will typically go with the DSCR option, not only to save these discount points, but there's also a lot of other flexibility. Our investors can refinance multiple properties to purchase multiple properties at the same time because there's no employment or income really involved at all. So these options are amazing. Also, if we scroll down here, you see we have a ton of different variations. Some of these may have different prepayment penalties. Some of these may allow exceptions such as bankruptcies and foreclosures, and some may allow things like short-term rental income. So a ton of different options we have here. Please get with our team to find the one that fits best. And now let's go into our topic for today. Let me switch my screen and we can go ahead and present Jose's topic, which is pretty simple, as Kyle spoke about before, which is FHA loans. Pretty standard product, right? A lot of people think it's a pretty standard program, but there are a ton of tips and tricks and variations we can do within the FHA. Also, I'm sure Jose is going to talk a little bit about what FHA can do compared to the other programs, but he's going to show some examples of some obviously different ways to apply these programs. So remember, FHA is a government program, so this isn't for investment properties. They do allow multi-units, though, which I'm sure Jose is going to touch on. And just remember that these programs do require upfront and monthly mortgage insurance. So that's the biggest difference. But I'll let Jose go ahead and get into the details here, and then we'll pull up some live examples. So you ready, Jose?
Good morning, everybody. Thank you for joining us. Daily Rates Live with the Mortgage Calculator. Great to be with you this morning. Before I get into showing you some rate examples, just wanted to discuss some of the misconceptions, or should I say preconceived notions of FHA loans. Is that mainly most people think that FHA loans are for first-time home buyers, right? That's what I hear all the time when somebody says, hey, I'm a first-time home buyer. Can I qualify for FHA? So, they're all under the impression that that's the only way that you can get into an FHA loan. And It's not exactly that way. What it really boils down to is that FHA is for primary residences. So I think that's where people uh, get the misconceived notion that it's for first time home buyers, right? And also, FHA is not necessarily for people with, bad credit, quote unquote. It's mainly just for people. I shouldn't say it's for any type of individual. It's just a little bit more lenient with how credit is treated, right? In terms of mortgage insurance, for example, conventional loans, the mortgage insurance is based on the credit score of the individual, whereas with FHA, the mortgage insurance is based on the loan to value of the property. So if you're 95.0% and below LTV, you're going to have a lower factor than if you are 95.01% and above. Right? So, and the other thing to consider on the FHA loan is that the mortgage insurance stays with the loan for the life of the loan unless the initial loan to value when the loan is originated is 90% or below. If the LTV is 90% or below, then you can eliminate the mortgage insurance when the loan gets to 78% loan to value. So that's a key difference there, because on the conventional loan, um, you're only required mortgage insurance at an 80.01% and above, whereas on the FHA loans you're always required to have mortgage insurance, and then on the conventional loan you can usually eliminate the mortgage insurance when the LTV gets to 80% or below, no matter what the initial LTV was. And on the FHA also, I believe there's also a time constraint regarding the time that the MI can come off. It's not just loan to value, but I believe last time I reviewed those guidelines, it was 11 years. So if at 11 years, after 11 years, you're still in the loan and you're at 78% LTV or below, then you can petition to have the mortgage insurance taken off of the property. The other factor to consider with FHA is that you do, as Nick mentioned, you do have an upfront mortgage insurance premium, which is an additional expense aside from the regular mortgage insurance that you pay on a monthly basis. The upfront mortgage insurance premium is 1.75% of the loan balance, and it is usually financed. The borrower has the option to either pay it as an out of pocket closing costs if they don't want to have a higher loan balance, or they can just finance it. So the end result is, although the FHA borrower may be giving 3.5% down, usually they're going to give the minimum down payment, and the base loan is going to be at 96.5% LTV, the total loan amount is usually going to put them a little bit above 98% total LTV. So it's like 1.75% higher. That additional financed amount is going to affect the monthly payment a little bit as well. Now, conversely, FHA loans, if you notice from the rates that Nick was just showing, usually do have a little bit of a lower rate than the conventional loans when everything else is equal. And that's probably because of the additional assurances that are given by the HUD mortgage insurance and the upfront mortgage insurance, right? Those are additional assurances to the investor or lender that is funding that loan, that they could be made whole should there be the need to foreclose on the property, right? A little bit of additional liquidity as well, because you do have the backing of HUD and the U.S. government, not like private mortgage insurance and the privately backed loans, right? So FHA are going to be a little bit lower, and also everything else being equal, FHA loans are going to be a little bit more lenient as far as the interest rate and the FICO scores and loan level price adjustments. So that's where you're really going to see the difference. If you're sizing up a deal and you have a borrower with a 640 credit score who's looking to come in with as little down payment as possible, you're usually going to have a lower rate and a lower mortgage insurance cost for that 640 credit score borrower if you go FHA as opposed to conventional. And also when you're running your automated underwriting, just because Fannie Mae or Freddie Mac guidelines say that the minimum credit score is 620 does not mean that you're going to get your approval for that borrower with a 640 credit score. There may be issues going on with that borrower's credit. They may be overextended with their credit card, which could be why they have that lower score. They could have some derogatory credit, which is the reason why they could have that lower credit score. And that could result in not obtaining the automated underwriting approval that you seek for the conventional loan, but you would probably be able to obtain the automated underwriting approval for that borrower under an FHA loan. So a lot of different reasons to go FHA. However, one thing you should always note is don't just pre-qualify or pre-approve, should I say, your borrower just for an FHA loan. If possible, you should try to pre-approve them for whatever other full doc options are available. If you can pre-approve them for a conventional loan as well as the FHA loan, because I always recommend that you reach out, or the borrower reach out to their real estate professional that is going to be assisting them in the local market where they're going to be purchasing, if this is for a purchase, to ensure that they have the best pre-approval loan type out there for the offers that they're going to be putting out there. Because in some of the tighter markets, there is again, talking about preconceived notions. There is preconceived notions that the FHA buyers may be weaker for whatever reason they may think that than the conventional buyers. So always be on the lookout to pre-approve that buyer also, let's say for a 3% down option if applicable, or a 5% down option, conventional, both of these, as well as the FHA option, so that your borrower has as many tools and your borrower's realtor has as many tools at their disposal to be able to land that contract. That's all very important in how you're structuring your deal. So let me share with you some purchase options and some refi options here. Now, Nick did share with you a standard purchase option quote when he was doing his rates for FHA. So I'm going to be showing you some other options here, and we have a blank screen. Here we go. Internet must be a little slow. So first option I'm showing you here, going right to the interesting ones here, is an FHA down payment assistance purchase option, right? Down payment assistance loans usually need to be combined, or should I say down payment assistance, any of those programs usually need to be combined with an FHA loan. They can be combined with a USDA loan as well, but not with a conventional loan. Just keep that in mind when you're looking at your DPA options for your borrower. In this case, our DPA option that we like to work with is a lender paid option. And what I mean by that is not a separate broker fee charged to the borrower as is usual in many of the DPAs. And that has to do with the pricing that is usually available when you are incorporating DPA, down payment assistance is what I mean by DPA. When you're incorporating DPA into a loan. With the one that we have, it's a great option. So here it's so good that you can actually see, now this is 3.5% of the purchase price down payment assistance. So essentially You could either consider that you're going to get your whole down payment covered and would just have to come up with the closing costs. In this example of our $450,000 purchase, it's $15,750 that the borrower is going to save from their pocket, and then they just have to come up with the closing costs. And that's where maybe you can try to get a little creative with seller contribution, but then again, don't make seller contribution an absolute need. In order for the borrower to be able to get the deal, you have to set the expectations. We are in a very tight real estate inventory market, so check with your local real estate practitioner to make sure that seller contribution is viable. But then again, that's the purpose of the DPA as well. So here it's such a good option that we even have an $866 lender credit here on this deal with a 7.5% rate. So if you saw the rates that Nick was throwing out there, this is not much higher than what you would find for a similar rate with an $866 lender credit. Absolutely no loan discount buy down for this deal. So that's pretty cool. So now, throwing out another one out at you here, we're going now with the ultimate house hack. Nick did mention, and he knows how I love the 2 to 4 unit house hack. So here it is. So this pricing is valid for a 2 to 4 unit, whether it's 2, 3, or 4. It is the same cost. No loan level price adjustments. And actually, it's the same cost as a 1 unit as well. 1 to 4 unit, FHA, no loan level price adjustment. So if you notice the rate I just showed you at 7.5% with and that $866 actually translates to 0.196 points lender credit, or $886. So here 7.125 is the lowest cost option at a cost of $552, just a little bit over 0.1 points. And you can buy it down all the way to 5.875. So that would be great for your borrower looking to get that 4 unit property, right? They live in 1 unit, rent out the other 3. Now, when you do have a 3 to 4 unit property, there is a sustainability requirement, meaning that in order for that loan to be able to be funded, the property would be able to cover its own housing expense should all the units be rented, assuming borrower wasn't living in the property, which obviously they will be, but that's just a test that they do. So if the projected rental income from all the units cover the complete PITI, then I guess we were talking about, for those of us that love our DSCR loans, we'd be talking about a DSCR, a debt service coverage ratio of at least 1.0, then that's a viable loan, and that loan would be possible. So on the 3 to 4 unit, it's not just looking at the DTI of the borrower, but the DSCR of the property should all of the units be rented. So that's a real important point here to consider. So now we're looking at another interesting twist, that FHA 203K loan. This loan is available in 2 options. It's available in the streamlined option, which has a maximum loan amount of $35,000 the last time that I checked, or a non-streamlined, quote unquote, regular option, which does not have that $35,000 maximum loan amount. Now,
you mean rehab budget, not loan amount?
Yeah, excuse me. Yes, rehab budget. Excuse me.
Gotcha.
Now the reason that they do that is, obviously to streamline the process, right? But what they do in the streamline is they eliminate the need for a HUD consultant to come in, review the whole project, and make sure that you're covering every angle of the transaction. Because what happens when you bring in the HUD consultant, and remember, this is really for the benefit of the borrower, but it could also complicate the deal, because it may increase the scope of the work and put you above and beyond that $35,000 budget, and which in that case you may either have to trim down the rehab that you're looking to do or switch over to the regular 203k option. Because what could happen if they were on the streamline to bring in the HUD consultant is the purpose of the HUD consultant is to come in, walk through the whole property and make sure that there aren't any livability issue items that are not being addressed, right? So besides what you want to do, and this is then what's going to happen on the regular 203k, is they're going to see the scope of your work that you have, right? Estimate and all that kind of good stuff. Then they're going to go to the property and they're going to make sure that you haven't missed anything that should be taken care of according to FHA's housing standards, condition items. So anything that they feel, maybe, door locks that are improper door locks, maybe wiring that's incorrect, maybe you weren't planning on painting the whole house or something, but they could find something wrong with the paint. Maybe they find something wrong with the roof installation. I mean, whatever, they're going to go through the home with a fine-tooth comb. So in order to avoid that and the extra expenses associated with using a HUD consultant, not just the extra expense of their fee, but the extra expense that may be incurred when they go through the property and say, hey, listen, you missed this and this and this and this and this and this. And now all of a sudden you've added $10,000 or $15,000, $20,000 to the scope of the work, higher loan amount. It may put you out of the range of where you need to be according to the after repaired value of the property, because the 203k loan is going to, on the appraisal, size up the property's as is value, detail the renovation that's being done, and then you're going to have total costs, and you're going to have an after repaired value, and you have to make sure that your after repaired value is at least equal or greater, hopefully, than what you are paying for the property plus the cost of the improvements. If it's not, you're going to have to trim down the scope of the work, and usually it's going to be from the items that you chose to add on and not from the items that the HUD consultant said that you needed to include, right? So at that point, you're like, oh my God, he's making me fix a lot of stuff I didn't really want to deal with, and now I'm not going to be able to remodel my bathroom, for example, right? So just look at why you would consider a streamlined option versus the complete option. Obviously, the complete option just doesn't have a limit on the amount of the loan. It's only going to be limited by the ARV, right? So it's real important to know how that works. And as you can see here, the rate is not much higher. It's only 0.125 higher. If we go back to the other one here, notice this one was 7.125 with a 552 loan discount cost, and this one is 7.25, so just an eighth of a point higher. Now, the same FHA 203k is possible as a refinance, right? So you can refine. Now, there is obviously a little bit of a higher cost here. You see 7.25, $1,105 in cost, but for those borrowers that are out there that maybe were looking for a home, haven't been able to find the home, there's very limited availability inventory right now. So maybe they've been looking for 6 months, maybe they've been looking for a year. They're totally frustrated. You may not have to sell your home to buy another one when you could possibly convert your existing home into the home of your dreams. Maybe you could get that garage and you could legally convert it into a master bedroom, for example. Maybe you could get that built-in terrace and convert it into a nice family room legally. So a lot of things that you can do with this program, but what you cannot do is add foundation. Because this is not a ground-up construction program. This is a renovation program. So that's why you'd have to be looking for already existing spaces to recondition or redistribute the space, but you sort of got to work with what you are already dealing with. And last but not least, FHA cash outs. The FHA cash out limit is 80%. Used to be 85%, but those things changed uh, during the pandemic and they didn't increase them back to where they were. So you still see though great rates here. 7.125 is your lowest cost option, and you can buy it down to 6%. Uh, so there are very good cash out options, but note you do have to know what the LTV limits are, because FHA is really not made for this option. But however, if you compare it to Fannie Mae cash out or Freddie Mac cash out for a single family home, it's the same. However, where FHA is going to excel is if you have a 2 to 4 unit, it's the same loan to value. There is no adjustment to the LTV and a 2 to 4 unit cash out, whereas Fannie and Freddie do have LTV adjustments for 2 units, 3 units, and 4 units. And these are all at a 660 credit score, by the way.
All right, I don't see any questions. Hopefully, shed some light onto some different options that you may not know have existed for FHA. You know, one of our favorites, the 2 to 4 unit house hack, is definitely a good program. So remember, we do this show at 11 a.m. Eastern every single weekday where we go through the live rates and then do a deep dive into a different topic. So we appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow at 11 a.m. Eastern for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.
Thank you, everybody.